Afternoon. I'd like to discuss the announcements made by the Chancellor Jeremy Hunt earlier today. If anyone has any technical issues, please feel free to contact us using the chat function. My name is Jack Bennett. Also on the panel this afternoon, we've got Jerry Surtees, who is a tax advisor here at Oldfield. It was just under 8 weeks ago, on the 23rd of September, that the then Chancellor Kwasi Kwarteng presented his growth plan to the House of Commons, including some sweeping changes to tax policy that was very unexpected. The autumn statement presented today had an extremely different approach, with a more balanced view on both tax policy and public spending. To protect the most vulnerable, the Chancellor unveiled £26 billion worth of support for the cost of living crisis, including continued energy support, as previously announced, as well as 10.1% rises in benefits, and the state pension also increasing by 10.1%. The Chancellor also announced that more than 8 million households on means-tested benefits will receive a cost of living payment of £900 in instalments, and that the national living wage will be increased by 9.7% to £10.42 per hour. And that would be benefiting 2 million of the lowest paid workers. The budget also includes further funding and support for public services, including the NHS and our schools, the education. Jerry, what did you think of today's autumn statement?
Well, the suspense has finally ended, and we're all digesting what the Chancellor has had to say. I think the general sentiment seems to be one of relief, really, that the tax announcements weren't perhaps quite as significant as expected. And it's, I guess, part of the technique that to hint at eye-watering tax increases, which then don't turn out to be quite as bad as everyone feared. From a business perspective, prior to the statement, there was a lot of talk of potential increases to capital gains tax. Thankfully, the Chancellor has left this largely alone, with no changes to capital gains tax rates and no changes to business asset disposal relief, which was previously known as entrepreneurs relief. However, he has reduced the annual exempt amount, which is the annual amount of capital gains that you can make tax-free, from 12,300 in the current tax year to 6,000 from April 2023, and again to £3,000 from April 2024. Just to put some numbers around this, that means that in the next tax year, for gains that qualify for the 10% rate, individuals are paid to £630 extra, or at the 20% rate, this will be £1,260 extra. So relatively modest changes compared to what it potentially could have been. Capital allowances are essentially unchanged. The 100% annual investment allowance that many will be familiar with is permanently fixed at £1 million, and that's been retained. And the super deduction will come to an end in March 2023, as previously announced. So just one to be aware of, and if you are making spend that qualifies for the super deduction, it will remain important to take advantage of this until the relief expires next year. Arguably the biggest change for business is to R&D tax reliefs, which, again, most on the call would be familiar with those. For most businesses, this currently allows an extra 130% of qualifying spend to be claimed against your company's tax bill. And this is now being significantly reduced to 86% with effect from April next year. The interesting thing, however, is when you run the numbers on this, the results are actually quite surprising, and you can see on the table that we've got on screen here that combining the 25% corporation tax rate with the reduction in the R&D relief means that, in actual fact, overall businesses will still get more tax relief than they do at the moment under 19% corporation tax. And you can see that from the numbers here. We're looking at R&D qualifying spend of £10,000 On the left-hand side, we've got current rates, what we call an enhanced deduction of 130%, corporation tax relief at 19%, giving a 4370 corporation tax saving. Looking at the right-hand side of the table at the new rates, we've got an 86% enhanced deduction, but we've got a 25% corporation tax rate. So the overall corporation tax relief is 4650, which is actually higher than it is at the moment. So just to kind of provide some context around that, really, and clearly R&D, spending on R&D is still a very good thing to do and very tax efficient. So the other thing is that what we call the RDEC scheme, for those that don't qualify for the usual scheme that we've got on the slide here, the RDEC scheme has been made more generous, and that appears to be a step towards simplifying and amalgamating the various R&D tax reliefs. Finally, just quickly on business rates, 2 support measures have been announced. One, freezing the business rates multiplier, so that's no longer going to go up. And the other one, offering transitional relief because rateable values are being reassessed in April next year. It will cap the amount by which your rates bills can increase by between 5 and 30%, depending on the size of your property. There are other rates measures affecting retail, hospitality and leisure, small businesses and property improvements. So that's it really for me, the key announcements on the business side of things. I'll hand you over now to Jack to talk about the personal tax aspects.
Thanks, Jerry. There certainly seem to be quite a number of announcements relating to the personal tax during this autumn statement. And one of the key announcements was that a number of the allowances and thresholds, which had previously been fixed up until April 2026, have now been fixed for a further 2 years to April 2028. So this includes the personal allowance of £12,570, the higher rate threshold of £50,270, and some of the national insurance thresholds as well. Now, obviously, whilst these have been fixed, as wages increase over the coming years, this will mean that more individuals will be pushed into those higher rates of tax over the coming years. However, it is staged based on their increasing pay. There were some changes that the Chancellor did make in relation to personal tax, however. So just looking at income tax initially, the main change there was in relation to the additional rate threshold. So typically, this has been set at £150,000. So that's where the income tax rate goes from 40% up to 45%. Now, it was quite widely rumoured before the autumn statement that the Chancellor would look to reduce this to £125,000, so a reduction in that threshold of £25,000. And he has indeed reduced the threshold to £125,000, £140. So just for those who are wondering where the Chancellor plucked this £125,140 from, this is the point at which an individual has lost all of their personal allowance. So at the moment, once an individual's income exceeds £100,000, they begin to lose their personal allowance. And it's tapered down up until the point that they reach income of £125,140, at which point their personal allowance is zero. So for someone earning £150,000 at the moment, obviously they will then start to pay more, 45%. But just to put it in context in real terms, it will just cost them an additional £1,243 per annum in tax. And obviously the key point being that this is aimed at those with higher income. Turning to dividend tax, the key point here was that the dividend allowance is also being reduced. So currently the first £2,000 of dividends an individual receives in a tax year are tax-free. However, from April 2023, this allowance will reduce down to £1,000, and then it will be further reduced to £500 from April 2024. And while this seems like quite a drastic reduction in the allowances that are available, if you consider a shareholder who is maximising their basic rate band each year through a combination of small salary and dividends, as many of our clients would be, that's actually only going to increase their annual tax liability by £131. So hopefully, an increase that can be absorbed. The freezing of thresholds that we spoke of earlier in relation to income tax, this also applies to some of the inheritance tax thresholds. So the nil rate and the resident nil rate thresholds, these are frozen again until April 2028. And I think the key point is this is going to make careful inheritance tax planning all the more important over the next few years, especially when you look at the last few years, how it's gone in terms of house prices, business value, cash. As they increase, these thresholds are remaining the same. So it's more likely that there'll be some inheritance tax planning to be looked at. And then on the subject of stamp duty land tax, many will remember that one of the few parts of Kwasi Kwarteng's growth plan that was actually retained was this increase to the stamp duty land tax thresholds. And this meant that people who are purchasing a house, and in particular those who are purchasing their first house, they pay less stamp duty land tax because the thresholds had been increased. Chancellor Jeremy Hunt did announce today that these increased thresholds would only be temporary. So they will fall back down to the previous levels from the 1st of April 2025. And then another couple of points to think of, touching on the subject of cars, the Chancellor did confirm today that the company car benefit in kind percentage would be increased by 1% per annum for 3 years from the 2025-26 tax year. But importantly, that is for wholly electric and hybrid vehicles. And what's interesting is that for petrol and diesel vehicles, there'll be a 1% increase in 2025-26 tax year, but they'll then remain fixed at that rate for the following 2 years. So the impact of that is that it's just marginally closing the gap between electric and hybrid vehicles compared to petrol and diesel vehicles. Now, obviously, that gap is still quite significant, and electric and hybrid vehicles are still going to be significantly more tax efficient. And then the other point that was confirmed in relation to electric vehicles is that vehicle excise duty will also have to be paid for electric cars from April 2025 onwards. However, in real terms, it's only expected this will be £165 per annum per car. And then the final point I want to mention was just in relation to council tax. And this was slipped into the Chancellor's speech quite subtly. But the government have increased the maximum percentage that local authorities can increase their tax rates by each year from April 2023. So currently, your council tax rates are set by your local authority, the area you live in, and they have a set percentage that the maximum percentage that they can increase rates by each year. And the government has just increased that up to 3% per annum. So your local authority could increase your council tax rates by up to 3% per annum. Hope that's helped to distill some of the key points that I mentioned today, Jerry.
Thanks, Jack. As always, there's always a fair bit to take in when you get down to the detail. But I think the overall feeling, as we said at the beginning, is it could have been a lot worse. The increases for the large part have been, for many people, relatively modest. And in fact, I think we'll find that for the vast majority of average earners, there'll be little or no impact in real terms, at least in the short term. Importantly as well, I think markets seem to have reacted well overall. So that's all positive things. I think it's certainly bringing about a measure of stability from what we can see. Before wrapping up, we just wanted to mention that our next event will be in early December on the subject of preparing for change in 2023, and there'll be some key business and tax points that you won't want to miss as we move into 2023. We look forward to seeing you there. A brief video will be released after the event summarising the key announcements from the autumn statement, and a recording of this event will also be available. As always, we'll be on hand to answer any questions you may have on how the changes will impact you, and please be free to get in touch with us by any of the methods shown on this slide. Thank you for listening to this brief event, and we trust you have a very good afternoon.